What's going on, everybody? Welcome back to WCP Minicast number 10. We've actually hit double digits, if you can believe it. We've had the attention span long enough to try to put this short form podcast, vlog, whatever you want to call it, out there and try to get people, a decent amount of content, some tips and tricks, and really excited to have hit number 10. I know it doesn't seem like it, but this has been great. Today, I'm joined by Kevin on our team. So we're going to be going over some pros and cons on rehab, starting with rehabs, buying a property that needs to be rehabbed to turn into a rental. We sometimes call that fix to rent. Versus buying turnkey rentals. So we're gonna chop that up today. If you hear any weird noises in the background, it might be the thousands of cicadas flying around and bumping into the window. So don't worry about that. Interesting times we're here. So
we got some of the new development around my area. It's just giant, beautiful buildings with windows, and it is a cicada's nightmare. They're hitting the windows, and it's just a graveyard. It's actually really, really gross. But yeah, it is a very weird time to be outside with these giant bugs.
Oh yeah, totally. Yeah, I'll enjoy my time inside and working on more mini casts in the meantime. Yep. So just jumping into this. From the lender standpoint, we're in this kind of unique position where we get to see a little bit of both of these two different categories of rentals, and what works and what doesn't. I don't know what you've seen, Kevin, in your own business, in your own book, but for myself, I would say the vast majority of people and loans that we work with are more so the fixed to rent, right? They're doing kind of the BRRRR method. It's very infrequent for us to get like a turnkey rental kind of scenario, unless we're doing like a bridge rental kind of 12-month, 18-month type of scenario where they already own it. They want to get a little cash out. It's already cash flowing. They've already got the tenant in there. And they're going to take us out with long-term debt again. Maybe they just got some money out to do repairs to the house or to down payment for another rental. So that's kind of what I see. What do you seeing the same thing?
Yeah. So it's super uncommon for us to see turnkey rentals. I don't know if it's because of the area that we're in. And I definitely think that has something to do with it, because I know if you go a little west, if you go into the market or something like that, there are a lot of people that are creating those opportunities for others. They're doing the BRRRR method, but they're not the one holding. They're selling for a profit, right? But I think it's very, very common in our market, especially because it is easier to get into a project like that, to have something to hold for a long term, and because more importantly, the BRRRR method is so popularized by all of the other podcasts, all the other content producers and things like that. You go anywhere, people are talking about the BRRRR method. People are bringing up the BRRRR method in our meetups and stuff that we do when we're not even talking about rentals. It's just something that's very, very common, very low right now, because it's a great idea.
Yeah. So this is probably a good time to ask, what does it even stand for? I mean, for those that are just new to rentals and maybe, checking out this content because they're curious on the pros and cons, like what is BRRRR?
Buy, and this is going to be really embarrassing if I get it wrong right now. Buy, renovate, rent, refinance.
Got it.
You're going to buy a property. You're going to buy a property that's under market value for whatever reason that is. And it could be because you have to fully gut it. It's because you're taking one building and making it into two rental units, whatever it is. You're going to renovate it. Then That's the second part. You're going to rent it out to a tenant. So now it's a stabilized asset. And then you're going to refinance out into long-term or 30-year fixed debt.
Got it.
Yeah.
And I've also heard a third or fourth or fifth R, I think is repeat. So yeah, people are doing this on repeat, rinse and repeat, because the model works and the debt now is out there. We've got a really awesome 30-year product that allows you to stack as many of these as you possibly can, because it's focused on the debt to income of the property and not the debt to income of you as a person, like looking at your balance sheet, which is many local lenders, regional lenders, kind of traditional financing methods. So I think that's part of the reason easy access to capital has allowed it to kind of blow up. So I totally agree with you there. Part of the reason I think that you don't see as much, definitely it's geographical for sure. Like I've seen a lot of turnkey stuff in the Carolinas. If we're just talking like East Coast, a lot in the Carolinas. We've seen this whole trend in like new home building to rentals with developers that are doing whole tract communities, much lower grade than what they would do, for if they were going to sell them, not hold them, but then just rent them out to get the cash flow. And obviously they have clearly got the land so cheap, and they've been able to build so cheap and spread it across so many homes in the community that, they can cash flow it. So
exactly.
Yeah. The other thing I think that's the reason we don't see it as much is because kind of inherently when you have a turnkey, right, somebody else already did the rehab work foreseeably. I mean, that's why it's called a turnkey, because it's all done. And that means you're generally going to have a higher purchase price, and you're going to have less people who are able to have enough cash to get into those. You're going to have a higher, really the key is you're going to have a higher debt to DSCR, or debt to income ratio.
Right.
That's going to that's going to lower the LTV and increase the amount of cash that they have to bring. So it's just they're not going to cash flow.
Well, the biggest thing is when you talked about the repeat portion of the Burr method, one of the whole points is that you're going to get into a property and your total cash into that, your total investment in that property is going to be X, right? But then you're going to refinance based on your now as repaired value, based on if it makes sense from a proper debt to income ratio and all that, sure. But it's likely that you're actually going to get some cash out, some of that initial investment in, so you can then do the repeat part. Whereas if you're buying turnkeys, not only do you have to purchase it for a higher price, there's no situation in which your investment is a year later getting sent back to you. You then have to raise enough capital, whether that be through working your 9 to 5 or whatever that is, until you can buy your next turnkey. Now, that's not saying that it's all negatives, because there are positives on the turnkey as well. You don't have to worry about the renovation if you don't have that knowledge. If you've never done that before, sure, that's something that takes off your plate. You don't have to worry about screening your first tenant. You're walking into a project that's set up. It might have a project manager. A bunch of different stuff can come with this service that you're buying. If it's not just, oh, I found this property that's already rented, I might pick this up. So it's not negative, but yeah.
Really good point. And I don't think it's a negative in the traditional sense. It's just, it's for different people, like if you don't have the time, if you've got a 9 to 5, like you said, then you may want to go the turnkey route. And, you can see this as a trend just in real estate, in the market itself, right? You have a lot of businesses that have built their business models around turnkey rentals. So everything from like a small solo entrepreneur that's just, has access to off-market deals and they're rehabbing them. They've got crews. I've seen a couple of really successful turnkey rental shops in Baltimore City that are just doing this like wildfire. And so you don't have to worry about the difficulties that come with construction in the city. It's pretty well known and documented. It's that the construction side is kind of tough, finding the right crews in the city. Right. So, that's a big piece of it. And if you just don't have the time, so it ranges from like really small mom and pop shops, like I was just mentioning, to full on tech companies. I don't know if you've ever run into Roof Stock. It's a startup that I actually met the founders. They were in our office. It's been years now, and like they've really had a lot of success and a lot of growth. But the whole model is just turnkey rentals, except with a tech component. So like anybody that just wants to buy rentals, they just go on there, and it's like, oh, here's 100 rentals for me to pick from. Here's your IRR. Here's your cap rate. This is the profile of the tenant, and like, have they been paying, like all that kind of stuff. So you get that information. It's all these houses, they've rehabbed them. So it's just adding a tech component, which everybody seems to be doing these days. And I'm sure that there are competitors of Roofstock, but not to just plug them.
Yeah.
But yeah, it's clearly like, if you're in the industry, I don't know if I would ever see you going to Roofstock and buying a rental necessarily. If you have access to some of the off-market networks that we have in our sphere, in our environment, like great DC deals, and access to a lot of these wholesalers, even if it doesn't work as a flip, like that could work as a rental. You should consider it.
Yeah. So, I mean, the roof stock is what it is. That's
Yeah.
a fantastic idea. And if you were to be a non-real estate investor, maybe without a lot of background and stuff like that, you're trying to get into rentals and just go on and browse, and all right, well, this one is only 20 minutes away from me. So if I ever need to go, that's the perfect house for me. Whatever cash I got on the side, might as well put it into this. I'm actually going to, it's a good investment, right? It's a long-term investment. That's a great thing. But for someone like an actual investor, someone who's not more of like the 9 to 5 doing this on the side type of thing, that's exactly right. And one of the things that, besides the knowledge, besides the access to the properties, is the access to the capital. And we've really structured our internal stuff where we're ready to not only provide the fix and flip product, but we now have our 30-year fixed rate product as well. So we can do the buy, obviously, and the renovate, because that's what we've always done at Washington Capital Partners. We've always had the fix and flip product. But now, once you have it rented, we can also do the refi part, and then it's on to you to repeat, right? So we have all that in-house now, which is very helpful.
Yeah, that's the number one thing I hear from investors when they come to me to say, look, I'm thinking about rentals. I may need to do construction. The number one thing people say is, I just want consistency. I want to aggregate all of my stuff with one lender. It's just way easier. You've got the back end servicing is all with one group. You don't have to think about like, oh, I have these 10 different lenders, and one uses FCI and one uses Cohen, these massive, national type servicers, and one uses WCP that does all of their own servicing. Hint, that's the best option for servicing purposes, is your lender that actually services it in-house. And it's just ease of use. So that's tremendously valuable for sure.
Yeah. We like to provide all the options. And now if there's ever a situation in which, someone's like, hey, I don't know that this is actually going to be a flip, I'm really looking to hold this as well, you don't have to wait anymore. We can do analysis of what these deals are going to look like in the future based on estimated numbers and things like that. So you're not going in blind, and your exit strategy is, well, I would like to have a situation where I could refi this later on. No, we know what the numbers should be, and we can give you a quote based on that a year before you're actually there and ready to put that into long-term debt.
Yeah, that's a really good point. I try to tell every bar that comes to us talking about maybe rentals, it's like, well, let's get you a quote. Obviously it's today, we're that far out, we're potentially a year out, but at least you have an idea and you have multiple options, depending on, who knows where the market's going to be. Things are looking good, but everybody knows that things are a little overheated. And so it's nice to have those different exit strategies for sure. Yeah. And, the other thing, again, when you're buying off market, you're able to compete better with a lot of the other buyers that are trying to do, buy these properties as flips. ideally you should be looking to be like at 80% or less. So the formula that we always use when we're looking at wholesales, right? And this is a good little side piece, but it's also kind of helpful for the rentals to know how much equity you have. You're doing the asking price, right? Or what are you buying it for, less the whatever construction there is, times 80% usually or lower. That's kind of the sweet spot of where you want to be. So at least getting 20% below market value to really build in for some of that construction, and you're getting a lot of equity built in. So
yeah. And I will say that if anyone that doesn't live in our market is watching this and listening right now, they're probably thinking that you're crazy, because that's not what other people are taught for the rest of the United States. That's where we live. That's the DC market, and that's how much competition and demand there is right now, right? So, and that's how it's been for years. That's not just something that's based on this market right now. But the one thing I will say, besides that being a part of where we're from and the high prices that we have, the other thing with respect to there being a lack of turnkeys around here, especially in the DC area, is because of that high price, right? If you go on to any of the major people that are talking about rentals, like if you go on Grant Cardone's stuff, he's going to tell you over and over and over again that you should be buying houses that any other person can get qualified for. And that's a lot. There's a lot of inventory in this area that is immediately eliminated because it's more than $400,000 as is, let alone what you do once you actually get it to be a rental. So that's something to think about as well, especially for us when you're looking for it and it's not there. That's one of the reasons why.
Yeah, that's a great point. And as a good segue, and I apologize for the noise. I'm living in a construction zone. I've got cicadas. I've got a baby downstairs. So sorry if you're picking up some of that noise. But what I was going to say with that is, as far to, at least if you're in this area, if you're in the DMV area, the affordability question, what are some good markets that people should focus on? Like we just talked about some of the positives and negatives of both. What have you seen? And I'll just start, some of the big markets that I've seen, obviously throughout Baltimore City, Hagerstown, Maryland, that's a big one I've seen. We have a client that's got hundreds and hundreds of single family rentals. They do a lot of stuff up in Pennsylvania, but surprisingly, they focus also on not surprisingly, they also focus on Hagerstown, Maryland. Any other ones that you can think of off the top of your head that people should be focused on?
So something that's like super, super specific is I see a lot of people that are doing Northern Virginia condos, right? So you're looking in Arlington, you're looking in Alexandria, you're buying a condo that's less than $200,000. Anyone can afford that rent, and you're renting it to a Northern Virginia family. Northern Virginia is arguably the most stable market in the entire world. So you definitely want to look at that like very, very specific thing. But we also love Philadelphia. Philadelphia is very similar to Baltimore, except in our opinion, in our analysis, it's got a stronger workforce backing it, right? So there's less volatility in that market. So we love Philly. We love the Philly suburbs. And then we are also, another part of Virginia that we're really into is the Tidewater area, Virginia Beach area. There are a lot of military families down there that are renting. So those are areas that we've catered specifically to be ready and able to transact in. That's where we're focusing on our best. I'm sure that you have some other areas that you were thinking of as well.
Yeah, people sleep on Virginia Beach. It's a great rental market. Hampton Roads in general. Have some family down there, and in some borrowers that do exclusively that Hampton Roads area. So and it's not too far away. I would say if you're 3.5 hour drive from the DC metro area, you can still manage it. If you're doing them yourself, you can make a once a month kind of trip down there, or even if you've got a management company, then that becomes less of an issue. But I've seen the Woodbridge area in Virginia, really, Woodbridge, all down the 95 corridor down to Fredericksburg. People really don't understand how much development has gone on in Fredericksburg, between Northern Virginia and Richmond. That's kind of like, a lot of people really view that as the cutoff in many cases of Northern Virginia, because people are still commuting every day up to DC from Fredericksburg. So I've seen a lot of stuff in that, from that point of view. Harrisonburg, the bedroom community of JMU, your alma mater.
Go Dukes.
Yeah, go Dukes. So I've seen tons of rentals in Harrisonburg. Really any college town too. That's like another good point, you know. Any place that you're going to have college students, you might have to have a little bit more, you know, legwork on the repairs, depending on who you allow to rent your units. But
My landlord had a whole bunch of problems, so that's for sure. So you definitely want to screen your tenants if you're working in a college town. But one thing that I'll say as well when you go to a college town is just this is a little tidbit, a little aside. Make sure that you're not renting on a per room basis. Make sure that you're putting it all on one lease, even though technically you're going to be on a per room basis. Everyone's got to sign the same lease, because for our situation, we don't like per room rentals. We want everything to be in one lease. We understand that in a college town, that's not necessarily how it actually is, but it's just something definitely to keep in mind. It makes everything easier when it comes to you getting financing if you have a long-term, at least 6 months, and if you have one lease, not per room.
Yeah, that's a really good point. Other locations, I mean, those are definitely some of the best. I mean, look, you can go, there's pockets all up and down the East Coast for sure. You know, we've seen some big stuff out of like Jacksonville, Florida. Yep. Some of the, you know, obviously Atlanta and some of the suburbs in Atlanta, some of the cities in Carolina. So really, like, there's a lot of really great pockets for rentals. You have to just know what you're getting into. Obviously, at the lower price point, you're going to be able to better cash flow. You're going to have a better, you know, better DSCR, you know, more income compared to expense on your property.
Yep.
Which is what that means. So yeah, just focus on what you're doing and have a plan, right? Like, don't just go into this. We talked about the pros and cons, but like, either way, whichever you decide to go with, have a plan. Like, do a business plan and say, this is what we're going to do. These are the neighborhoods, down to the neighborhood, that we want to be in. You could even do some canvassing. Like, if you want to spend a couple of bucks and you know you want to be in a neighborhood with rentals, like, put your family's face like on a postcard and say, hey, we want to be living in your neighborhood. I mean, somebody's going to reply to that, you know, and you're not just like the typical we buy houses fast kind of people. So that's an option.
Yeah, and you can do that though too. You can do the calls and you can do all that stuff as well. But yeah, absolutely. If you're looking to get into a specific area and you don't want to do the annoying, you know, we buy houses and stuff like that, but you also don't just want to sit and wait, why don't you call the other people that are obviously out of town owners, people that are obviously renting that property? The ownership is listed as they're listed as an out-of-stater, or they're holding it in an LLC or a corporation or something like that. That's something that you could quickly find by checking out the MLS or something like that. And you can call those people specifically or mail to those people specifically, instead of, you know, if you don't want to bother the homeowners in that neighborhood.
Yeah, really good point. I mean, there's a million, like, we got to do another mini cast on how to find rentals and how to find flips. That conversation alone, you could spend hours talking about all the different methodologies and everything else that goes into that. So we can save that for another time. But yeah, I mean, this was a relatively quick one. You know, we'll wrap it up here. As always, you know, we definitely should have said it earlier in the process, but for the purposes of the algorithm, of the YouTube algorithm, and wherever else we're going to post this video, please like, subscribe to the channel, like the video. It really helps get this content out to new investors, to new people. And yeah, we really just want to help as many people as we possibly can. You know, that's the goal. We see ourselves as advisors. not just lenders. And to the extent that we can help anybody out there that's just getting started or has some time and experience under their belt, we're happy to do that. So if you ever have any questions, definitely reach out. You can go to our website, WashingtonCapitalPartners.com, and reach out to a loan officer, and we can help you right away. So appreciate your time, Kev. This was great. And we'll be back with Minicast number 11 before long.
Thanks for having me.
Yeah.